Good morning, folks, and welcome to another episode with Felix Frey. This time, we're going to talk about how and when to trade straddles and strangles. But Felix, how you doing?
I'm doing well. Thank you for having me.
Absolutely, man. We've talked about so many different strategies. We've talked about call options. We talked about spreads, directional, iron condors, call writing as well. Today, it's about straddles and strangles. Before we kind of dive into what it means, how to trade it, when to trade it, where would you say this is in the complexity of trading? Like, is it a beginner level? Is it intermediate? Is it advanced? Is it don't do it at all?
You know what? It's not something that most people buy. Okay, I think the initial thought by most beginners is the idea that, wait, I don't have to pick a direction. I could just bet whether it goes up or down, and that's it. Why doesn't everybody do that, right? Because it's going to go one way.
Yeah.
And yeah, the last part's right. It is going to go one way. The part of the problem is how much you pay for that straddle or strangle, and how much is the expected move that you need to make in order to make this a profitable trade. It's very specific to buy a straddle. It has to be over some sort of event where you're thinking that something's coming out where the trajectory of the stock is going to make a significant move. And you also have to try to understand whether or not that straddle, these options are cheap. So one way you can do that, and the industry teaches it across all platforms and all over YouTube, implied volatility versus historical volatility.
Yeah.
So if implied volatility is high and historical is low, then it's, probably a little bit expensive. But if this thing is moving around and the option is cheap, meaning it's worth a shot to pay a little bit more to bet one way or the other,
Yeah.
then you would, consider it. But yes, people try to play it around earnings. And in specific situations, I know Goldman Sachs puts research reports, and a lot of times they'll use straddles in front of earnings because they are looking at a specific earnings and describing why that earnings is so important. Maybe there's new management, or the management's deciding this is the earnings call where they're gonna discuss 2-year strategy. So that is gonna cause something to move the stock in a significant way, rather than it's just another earnings call. Does that make sense?
It makes perfect sense. I often think about it as a way to find out different ways that you can go ahead and place a trade, even though it may be capping your risk, capping this. It just helps out a little bit in that regard as well. And I wanted to also thank you, because I was at a retreat this past weekend, which is why I'm in a hotel room. My flight's been canceled and delayed and all that fun stuff. But I was talking to a finance bro and never met him. We were just, small talk, led into whatever else. And he goes, yeah, JPM call. I'm like, no. You're not going to mansplain it. I know what that is. Felix Frey told me. I know what that is. So I thought of you, and that was kind of pretty cool.
It's awesome
About that. When it comes to, okay, so let me know, what is the difference in terms of a straddle and then a strangle?
Sure. Yeah. So simplest terms, straddle is basically buying calls and buying puts, or selling calls and selling puts at the same strike near the after money. It's generally how people think about it. So if our stock is Apple's 300, say 310, then we're going to buy the 310 calls and the 310 puts, and we're going to pay whatever the market is offering. Okay. And maybe the market is offering over 1 week, it's, $10. Over 2 weeks, it's $15, whatever it is. You need to make outside, you need the stock to go kind of outside that move. Can you make money before, expiration? Of course. If it makes a large move in the first 24 hours, 48 hours, that's best. You'll have a profit there. But time is of the essence, and you're paying a lot of decay. So without an event, near-term straddles, strangles will decline pretty quickly. And it starts becoming very difficult to make money once a few days have gone by without knowing that there's an event coming next Thursday, right before your options expire. So that's why you want to anchor the straddle, in this case, to an earnings event. Strangle is the same thing, buying calls, buying puts, except they're a little bit further apart. So instead of Apple trading at, say, around 310, you're going to buy the 300 put and the 320 put, right? It's a little bit outside of the active money. So you're giving yourself some room. If you wanted to sell that, you could sell that. Selling the strangle is half of the iron condor, right? So the iron condor that we talked about was basically selling out of the money options and then buying the real smaller out of the money options to protect it. Here, you're just selling the out of the money, the strangle, you'd be selling the out of money options, or you can buy those out of money options.
Yeah. One thing that often scares people when it comes to trading is capital. One thing that makes them feel at ease is options, especially if you're buying one, right? Because you know your risk is just fine. If you buy a call, you spend $200, that's all you're losing, worst case scenario. How much capital would you say one realistically needs to start trading these strategies specifically, whether it's straddles and strangles? And I'm also keeping in mind the PDT rule, which we're going to have to dive into that.
Yeah.
But that's where the framing of the question comes from.
So selling, I would say it's out of the question for most people because you're going to have to put margin up 50% on both ways, right? You have to put 50% margin on the call and the put. So it's almost out of the question for most people. Buying these things, it's just the premium, the amount you pay, right? You can't lose what you don't put up. And so that makes it easier. But these, anything over $100 in most stocks that people are looking at are 200, 300, 400. These strangles, straddles, they can cost $50. So that'd be, $25 side, which is $5,000 on one trade. And you're hoping for a large move. For the average investor, I would say focus more on calls. If you like the upside, call spreads, diagonals that we talked about, vertical, calendar spreads, things that will cost significantly less. And you're not sitting there watching, these straddles or strangles decay and you start feeling the pain, especially if you don't know what you're doing, so that's what I would say. Even, and it's not a sure thing that things are going to move, right? Look at NVIDIA right before earnings. The straddle was, I think it was probably about $12 or something like that. $13, $15, something like that. Let's call it $13.
Yeah.
The stock was down $2. It's not going to help. You're going to get really crushed on that next day. So, at the end of the day, it's probably best to stay away from the straddles, strangles. I mean, if you want to do the iron condors, that's fine, because you're not putting up all that margin. But, to sell the strangles, sell the straddles, way too expensive. And then to buy them, it's not something I think for the retail investor to be doing up front, when they're first starting. I think, hey, you like Apple over the next few weeks, here's a call. We talked about how you can find something that looks fairly cheap and you can buy that call and play that way.
Here, let's put together, and again, I want to make it very clear, folks, and I'll put the disclaimer up as I say it as well. The example that I'm about to just mess with is strictly just for the mechanics of how to put on a straddle or a strangle. It is not any prediction or bet of mine or Felix's in terms of which way the market is going. It is just to show what buttons you may need to press and what things you may need to do. Of course, TradeZero is a broker that we are using here today. Okay, let's go out to, say, the end of May. So this is May 29th options chain. And let's go ahead
Friday
on straddle. Yeah, let's go ahead and put on a straddle. What do I need to do?
So where are we right there? We're at 750 right around 749, 750. Let's use the 750 calls and puts. How much is that? Just add them both together on the offer.
I'm going to go on the ask and then on the ask here. So it's about 385,
right?
And 391.
Right. So 385 and 391 is 776, right?
Mm-hmm.
So 776, it's about, where's the market? 750. So it's about 1%. They're pricing a little bit more than 1% move for Friday.
Yep.
Now, you got a lot going on. The market's been drifting higher. Doesn't sound like it's impossible for the market to move 1%, to be honest. It's up 20% in the last 6 weeks. Looks fairly cheap and like aesthetically. But yeah, I mean, you would win if the market was below the break evens. You'd be profitable if it went below. So let's say 750 less 776. Is that what we said?
So I should go ahead and buy at the ask both of these 750s. Is that correct?
Yeah. So how much is it there?
It is 395 on the call side ask, and then 3 on the put side ask.
Okay. So 775, 7 3/4. So if you paid 7 3/4, right?
Yep.
You would be long that straddle.
And by the way, folks, if you haven't already recognized this, completely paper trading, again, just to teach you what the mechanics are. That's
Yeah, so there you go. So now 777. So you profit by Friday, you profit 72 and a quarter. So I'm sorry, 742 and a quarter, right?
Mhm.
So 750 minus 775, and then 757.75. So above 757.75, you make money. Below 742 and a quarter, you make money.
Now I know that you've got
It's that simple. Now
yeah.
it's easy to do. It's like you ever play poker? You ever hear that? It takes 2 minutes to learn, your lifetime to master. Well, there you go. You're in. That's it. It's literally that simple. And now you are waiting for potential announcements from Trump. If there's any big earnings this week, anything that's going to make this thing turn, even just a turn, right? The market's had a big move. So I don't think it's a bad, it looks cheap. Aesthetically, it looks cheap. There's a lot could happen in the next 48 hours with politically. But that's it. It's not rocket science. It's just, to do this over time. Remember the market's expectation. The market is smart. The market's expectations are built into these prices. And so, the market is all knowing. And if they thought it was so cheap, they would be pushing this thing up, high. So can you make money? Of course, but you're now against what the market is thinking. The market is thinking this is fair value.
Yeah. And of course, the market typically will go ahead and have to where um, Friday or weekend is where the news may come out, and then Monday might be the real
Right.
people may want to.
Exactly.
It looks
So
so.
think about this. You might get a move down. Say you're gonna move down $3-4 tomorrow, and you think, oh wow, okay, great, it's going in one direction. And by the end of the day, it moves back up $2-3. Are you gonna spend 7 3/4? Like, what's the plan? So this is great. You just did this. So now the question is, what's the plan? Where do you plan on selling these things, right? Because right now you're just doing this by saying, oh, I think something might happen. That's fine. Okay. But now we have to actually think through. Say, well, what is our plan of action?
Yeah.
If it's down 1% and the straddle's at, 1% by say Thursday morning, and the straddle's at 10, you paid 7 3/4. It's at 10. You're up 2 1/4. Do you actually take profit there? Do you let it ride? How do you actually manage it? That's where sort of this target that we keep talking about, keep saying to you that it matters, because it's going to help you decide what you do right now, right? What most people don't do is they don't have a plan. And so they're not thinking through what I just asked. And so they're just off the cuff going, it looks cheap. If something happens, it'll happen. Great. But you should be thinking through what might happen so that because the key about options is to be a little bit more methodical than you are with stock. With options, it's very important at least to say, goes here, this is where my bottom is, or where I think the low is on the stock. Whatever the option is at that level, I'm going to get out. I think it'll be up like 30, 40, 50%, whatever, and I'm going to get out. Above this, I'm going to cut it down or take some profits. And if nothing happens by Thursday and this thing's $3.50, $3 before Friday, you know what? I'm just going to get out at a 50% loss. That's how you have to be. You have to have that plan in place before you just did this. We kind of did it, just show the mechanics. But what I would tell people is, well, what's the plan here? Because if you don't have a plan, what happens? You start making up the plan as the days go by. Oh, now my plan is, tomorrow's a big. You don't want to do that. You don't want to do that with options, for sure.
Have you taken a real life trade that we can maybe examine recently in a straddle or a strangle?
I never buy straddles or strangles.
Okay, so let's talk about that. Why is it not a part of your portfolio or strategy?
You pay a lot. You pay a lot. If you have like real edge or you're paying a lot. But for the most part, I'd rather focus my attention on, hey, this stock is going to go up, and now I find this cheap, and now I can get max leverage on what I think. If you're looking at straddles and they cost these days, go look at like an Apple straddle. Let's consider an Apple straddle for the next earnings, just to give you an idea. So earnings are probably in August again.
Yeah, we can just say that it's going to be. Let's just say by this time he'll pop this up a little bit more.
There we go. So look at the 310 straddle. How much does the 310 straddle cost in August? Take out the 29th this week. This is.
Oh, sorry, I went to the wrong one.
That's all right. I think you gotta untap the 29.
There you go. Could be.
There you go. Yeah, 310. So let's add that up. How much is it? 1655.
Yep,
And what's that? 1315.
and 13.15.
All right, so 2970, right? 29. Let's just call it $30.
Mhm.
$30 around 310. So you're talking about a 10% move up or down. So before you make any money, you got to get past 10% move in Apple. Apple's just had a big move, right? It's probably up about 10% in the last 3 weeks.
Mm-hmm.
And so now you're saying, look, it goes all the way back. It goes back lower, or, it's going to zoom a lot higher here.
Yeah.
Fair. But 10% in Apple is still really hard to actually get, like, especially without an event. They probably have a June developer event coming up. But still, what happens with the straddle is that, for example, you can move up to 320, right? And you're thinking, oh, wow, we're moving in the right direction. I think it's going to explode. And then all of a sudden you get 3 bad days in the market and Apple comes back down to 310.
Yeah.
This straddle is going to start getting really tough to beat. And so you're always against the clock, and you're always, it feels tough to hold this thing. You just start whittling down each day. So that's the reason. I mean, it's just hard to beat both directions, right? So if I'm thinking about Apple going up, right? And I was thinking about Apple going up after the earnings. I didn't buy any calls, but I was like, it's trading so well. Bernstein and everybody else was positive. And I was thinking, all right, but to buy the calls, you still had to expect a 10, 15% move. And I was thinking, Apple just doesn't move that way. Hasn't moved like that for, 6 months. And sure enough, now it just keeps on going, and it's done that well. But it's just really difficult to beat the market adding both sides to the table.
Yeah.
So I would just rather play one side.
And, typically, like you said, it's when Fed announcements are coming, when you have earnings coming, you have any other CPI numbers, whatever the case is. I think it's a great way to kind of put it, to where iron condors are like, all right, it's going to stay between this, right? And then the other aspect of what we're talking about is anything outside of this is where we're going to go ahead and make money.
Yeah.
That.
I mean, that's the allure of the iron condors and selling those, because it is difficult to get through that. The problem is, if you do that mechanically, the market is, again, all-knowing, smart, and you'll probably get caught a few times. You just got to prepare yourself for that. That's all. But I'd rather just focus on situations where I think it's priced incorrectly, meaning I think the stock's going to make a massive move up or a massive move down, and just wait for those moments and just pick, instead of playing every day trying to find the next straddle, because it's really, really difficult.
Gotcha. All right. Let me go ahead and get the other aspect of what I wanted to ask, because when it comes to these type of strategies, I always feel a little nervous. Are there other legs that people can put on to enjoy the strategy, but maybe not take on as much risk? Like, hey, maybe you sell.
I love it. Just sit back with a cigar and enjoy it.
I feel like I went to Harvard or Wharton and I got a degree, even though I did not, which I definitely didn't, by the way, folks. But what I'm saying is, like, typically you buy one, buy the other, right? Where if it's there, I'm feeling a little biased.
Let me tell you.
One side.
Let me tell you. I just told you, Goldman Sachs puts out research, and many times they're recommending a straddle. I don't think it's a bad idea. You have to be very, very specific at what you're looking at. Where there's, something like, I'm just throw something out because I'm looking at the software name, something like CRM. The thing's gotten killed, right? People have been buying it all the way down. The earnings comes out, they still can't get any lift. What's going to happen here? Is this thing going to zero, or is this stock going to rise, 50, 60 points on the next earnings call? I don't know. But if you look at that straddle right before earnings and you start thinking, this is pretty cheap for how much it could potentially move. Either people are going to be caught off guard here and this thing's going to drop significantly, or like there's a big technical level underneath. That's the situations where things are, get exciting for shadow. And Goldman does pick those situations pretty well. I've followed them for many, many years. Not always right, but they're picking very, very specific earnings events, and they'll describe what they're thinking. They're saying, new CEOs here, they looks like they're going to change the strategy. They'll be talking about the next 2-3 years. If the market likes the CEO, can they give it that big boost? And you know what? They're pretty good at it but again, it's backed by deep research on specifically an earnings event that might change the trajectory one way or the other. They're not sure, but it should be a lot.
Yeah.
Add technicals into that, and then you got yourself a nice story.
Well, it'll be interesting. Of course, I think every trader does this. When you think about strategy, you're like, huh, I knew this event in this stock was going to happen. I could have used this. You hindsight trade.
Hindsight. It's always, think about this. Think about how many straddles there are every single day that don't work, but you could, of course, if you see things, it's priced well. Generally it's priced well. And that's why I say deep research can uncover certain situations where, this looks a little bit off.
All right. Well, I appreciate you kind of teaching us this. I think what we'll do is kind of as we continue, we might, folks, you can always email us with your feedback. We might kind of redo all the strategies again and maybe have some real life examples of the past or the future so we can actually go through the mechanics of it instead of just kind of verbalizing. I think that might be something that we could mess with.
I mean, look, you just did something today. I think we should do more of that, even under virtual, just pull up different names. Look at, for homework, I'll let you look at Honeywell. Something that I'm looking at. So it's like the big events coming, a lot going on. Are these things too cheap? And then but again, it requires understanding a little bit about the stock and what the stock does.
Awesome. Well, appreciate your time. Appreciate you guys watching at home, and we'll see you later. Bye-bye.
Take care.